If you're in the real estate game or the stock market or generally just interested in the economy, somebody that you likely follow is Jamie Dimon. He's obviously the CEO of JP Morgan Chase or JP Morgan. He was most recently, I think this came out on May 23rd, maybe May 24th, talking about he fears or anticipates that the Fed may have to take the federal funds rate all the way to 7%. I just want to have a conversation with the one and only Anna Kelly about what would happen to the housing market. We'll stay single family for now, maybe work in commercial. If the Fed funds rate is 7, it wouldn't be unrealistic to think mortgage rates are 10%. So Anna, I don't know if
Right.
you've given this any thought, but let's just play with it. What would happen to the housing market, maybe even commercial, if interest rates were truly 10%? What are your first thoughts?
My first thoughts are I don't think it's that likely that we go that high. It's possible, right? And
Sure.
a lot of it depends on how sticky and how bad is inflation, and do parts of inflation increase and rear their ugly head worse than what we thought. I think it's going to take a lot for that to happen. But let's just, for this discussion, assume that yes, it gets to 7. Interest rates are probably, like you said, 9.5 to 10%. It would really impact the housing market. Commercial would be in much worse position. So maybe we take housing first and
Yeah,
then commercial.
let's do it.
I think, we're already seeing significant unaffordability in this country, higher than I think what we've done probably all the way back in our spreadsheet, right? That went
Mhm.
back to 70s. Is this
Yeah.
the most unaffordable
19,
time?
1981 is the one year that is still worse than today. It's only one year.
Okay.
That was when rates were 18 or 19%.
But still our lifetime, right up
Yes,
there with the most unaffordable. And so
correct.
when you have high prices and high rates, it really hurts the housing market in terms of affordability. That can help apartments because you're going to have more people that just can't buy and they're going to need to rent. So rents will probably go up because you'll have a new supply of even more people that are renter households. So rents may go up, and if you're a landlord, that's a good thing for you. But once housing is so unaffordable, if those rates stay that high for a long time and people simply cannot afford a home, housing values have to drop. Even if supply is tight, that's a pretty high interest rate for a long time. It's going to make people have to make a decision. Either everybody can only afford starter homes, or the prices at least of above average homes, the second tier homes, are going to have to start coming down. So why don't we pause there with that thought?
Yeah, I think again, I think one thing about interest rates is, yeah, 10% interest rate would have an immediate, I mean, immediate impact on transactions.
Yeah.
You would see contracts canceled. You would see nobody going to open houses. You also incidentally probably would see less supply because again, most people sell to buy something else. So the
Right.
entire housing market would grind to a halt. What would you
Yes.
be left with? There is always death, divorce, job transfers. So you would
Right.
have the must sell. Then you would probably have price. You would take a price hit because again, the must sells and your buyers are going to be cash buyers for the
Right.
most part, or maybe 50% down. So again, transactions would go from the anemic 4.2 or 4.3 today, probably into the twos. I mean, it would just crater.
Right, because it's already coming to a grinding halt, and we're at what, close
Exactly.
to 7% interest rate. So think about what that does if you go up to 10. It really slows things down.
Oh,
So yeah, I think part of what's kept us from having a crash in prices has been the fact that we have 70-80% of homeowners in really low 30-year fixed debt. So they're just not going to move. But to
mhm.
your point, those that have to, they're the ones that become so motivated because they have to, that the only way that they can sell their house is to really drop their price in a lot of markets. And so,
Yeah.
I think if you're not in an area that has a lot of great jobs, and more, housing demand than there is supply, then your values will start to drop. But the other thing is, I think if rates are that high, it tells you that inflation is still really high and the Fed is not stopping. And so what that also means is you're probably going to head into a very deep recession, at that point. And so if you're in a deep recession where people don't have a lot of jobs, and they start to have to sell their house, for other reasons, then you're going to have more supply come on, and that could start to really bring values down too. So
Yeah.
aside from the government putting programs in place, and we can spend a little bit of time on this and maybe even do another topic on this, you'd be in a real conundrum. I saw two things in the last couple of weeks that were real interesting. One of them was basically a 99% down, home program for first-time home buyers, or any that I think make $125,000 or less, if I read it correctly. The second thing, and it just hit my news feed today, and I didn't finish reading it, but essentially what they're doing is they're trying to come up with tax credits to get people to buy houses. So even though they already see at the rates where they are today, the housing transactions come off a cliff, they're trying to kind of boost that a little bit so prices, don't stay so high because of the lack of supply. They're trying to get buyers to keep buying despite the interest rate. And so these programs, hey, we'll give you a big tax credit if you buy a house this year, or
Wow.
we'll let you finance it with 99, percent finance. That's going to try to motivate you to keep buying a house, even though rates are at 10%.
Yeah. The other thing that I think would happen if rates got to 10% is home builders are going to have to change what they're doing. Right. Home
Yes.
builders can only buy rates down so low. And I think one of the things that would happen to the public, at least the publicly traded home builders, is they would almost immediately start building smaller homes.
Yes.
And frankly, I think smaller homes are what's needed, right? I think the average home built today is like 2,400 square feet or 22 or something like that. I think if we had 10% mortgage rates and we had them for any length of time, you would see the new home size cut in half. Right.
Yes.
I
And
think
we're already
that's,
starting to see that in some markets. We're starting to see much smaller homes, and the starting at price falling. You still have some bigger ones, but a lot of people buying those smaller homes already because of where interest rates are and what it does to their payment. If they give up their, bigger home with a lower interest rate and move, they've got to move into something smaller. So I'm seeing that, as well as more build to rent.
yeah.
So some of that slowed in certain markets, but other markets, there's still a lot of build to rent, because people know that if housing gets more and more unaffordable, more and more people are going to have to rent. I also think, Michael, that you probably have a lot less homes built, because what a lot of people don't realize is a lot of home builders are using variable mortgage debt in
Correct.
order to get the construction loans to buy the dirt and then to build the property. And so they've only got a year, and they can't lock in those loans at a fixed rate. So you have rates go to 10, they're under pressure to quickly turn those homes, and their holding costs of that new construction home on their debt is really high. Then they got to really incentivize you to come buy it. So you've got to have some really great incentives to get people to take those pretty quickly so that you can get out of your construction debt.
Yeah. Then the other thing that I'll point out at this, and then we'll switch to commercial real quick, is I actually think landlords who bought before the rate increase and had 30-year fixed rate debt are going to be, frankly, really happy. Because again,
Yes.
in that kind of environment, you're having inflation. Also, you're having less people buy, so you have more renters, and you
Yes.
probably would see rental rates go up, letting inflation be your friend. And again, we're pretty unique in the U.S. with 30-year fixed rate debt, and if you're lucky enough to have a 3 or a 4, and now suddenly it's 10%, you are just smiling. Yeah, your value may go down, but who freaking cares? You're printing cash flow. So I think that's something else that
Right.
probably happens.
And that's one of the beauties of holding, rental property for a long time is you don't really necessarily care about value and blips in value as long as you're cash flowing well. And if you bought properties in the last several years with really low interest rate, you are cash flowing well. And I'm starting to see the benefits of, I had a bunch of properties where I did the Burr method. So I got the first, rehabbed, and then pulled out equity, put a second mortgage on it or a line of credit. And a bunch of my seconds are coming due, and I'm just paying them off because the rates are jumping. And even paying them off, I'm like, wow, my loans are almost paid off on
Yeah.
some of these that I bought,
Yeah.
2009, 10, 11, 12. It's like, wow, it's really nice. So that cash flow just keeps going up, up, up over time.
Yeah.
And you don't have to sell when you're in an area that has a lot of housing demand, very low supply. You stay full, you can raise your rents and cash flow well. So we're able to kind of weather this without going, oh no, my property value dropped 10 or 20%, because it'll come back once rates
Yeah.
come back down at some point too.
So if we
Um,
switch to commercial and you have a 10%, again, if you have a 10% kind of, or what was it, 7% funds rate, the 10 years probably 8 or 9, maybe. So you have a
yeah,
risk
here's
adjusted
usually
return
about
at 8.5, 9. I mean, that's got to hurt. Cap rate's got to go up. It's got to make new deals worth less. It's just got to be just traumatic to commercial real estate.
Absolutely. So I'll talk about multifamily because the cap rates in multifamily tend to be the lowest across other like industrial, office, retail, et cetera. Meaning that if you paid all cash, you're getting a lower return, on apartments than you are some of these other things because it's less risky than some of these other things like office and retail. I'll just use as an example. But the average risk premium, since they've been really tracking cap rates and multifamily, is about 230 basis points above the 10-year treasury. And so,
Okay.
the 10-year treasury is going to be pretty close to, the Fed funds rate. So let's say we're at 7,
Okay.
you're going to be 9.3 caps for A-class brand new properties, Michael. Things are selling nationwide, brand new A-class, 3.5 to 4 caps. So
Oh my goodness.
literally you're doubling doubling to tripling your cap
Tripling.
rate
Yeah.
if
Oh
if
no.
that rate stays high for a really long time. And that's the risk that not a lot of multifamily operators or commercial people will tell you about.
Yeah.
Again, the question is, how long does that last? If we're in
Of
a
course.
new era of interest rates staying high,
Yeah.
then cap rates always follow. There's usually a
Yeah.
lag. It's about a year, right? And
Sure.
so we're just starting to see some cap rates start to rise, even in the Class A stuff. Class C, goes up much higher. But you have to realize that when investors are buying institutional quality assets or anything commercial for that matter, they're always saying, what's the risk premium that I'm going to make above the risk-free rate of return, which is that 10-year treasury. So you can't have a 10-year treasury go up and stay up for a long time without that cap rate, that risk premium staying the same. And people saying, hey, if I can get 7, why would I buy something at a 3 cap, a 4 cap, or 5 cap and have the headache of
No,
all
you
the things
wouldn't.
that could go wrong with ownership, with the
Yeah.
maintenance of the property and tenants not paying or vacancy rates going up, rents coming down. You would just take the 7 all day and multifamily would dry up just like everything else. So it
Yeah.
would really be pretty catastrophic for values in commercial real estate. And the really tough thing is just kind of a double whammy is that as you have these, let's say this is like worst case scenario,
Yeah.
right? But you have these 7% rates and they stay that way for a couple of years. You now have values that are tanking, but you also have debt that's looked at every quarter to every year by the lender. We provide P&Ls, we provide rent
Mm-hmm.
rolls, and they're going to look
Mm-hmm.
and say, what is your debt service coverage ratio? What is your loan to value? And if there's a year where your debt coverage ratio or your loan to value is now not in line with what it was when you bought that property, your value could tank. You could still be collecting rents, but because your value tanks, guess what the lender's going to do? They're going to go, you got to pay down this loan now. So your property that was worth 10 million and we had a $7.5 million loan, it's now worth 5 and you got to be 75% LTV. By the way,
Yeah.
give us $4 million check or we call your loan. Like people
Exactly.
will lose properties. So it would be devastating to the
That is
commercial markets.
That's exactly where I go with this. Residential is insulated because again, if you're a landlord who's locked at 3.5 or 4 and values fall, they don't call the loan. That's not how it
Right.
works in residential.
Right.
So again, you can hold and collect cash flow and wait to the other side. Commercial, if it stayed there for years, I don't know, it's like 30% of loans are resetting every 2 years. That's just how it works on the cycle. It would be
Yes.
catastrophic. Banks would go out of business. The biggest of big banks would go
Yes.
out of business if this happened.
Absolutely. Because they'd have to write down the debt. And this is
Exactly.
exactly what happened during the savings and loan crisis of the 1980s.
Exactly. Exactly.
And
Exactly.
not that everything is exactly the same, but when you have properties that are when you have loans that are collateralized by the value of assets that have been historically pretty strong, and in the 70s and 80s it was farmland, it was oil wells, and it was commercial real estate, and suddenly interest rates go so high, those values plummet because there is no longer that risk premium. And then the banks call the loans because they have to, because there's even tighter banking regs now that say your loans have to be healthy. They have to meet, these criteria. Otherwise, you need to have them paid off. You need to call the loan or you need to increase reserves. And so we have a period of time where we have this asset bubble where everything's gone up in value that's collateralizing loans, whether it's corporate debt, commercial debt, whatever. When that bubble pops and values come down, the value of collateral goes down and the banks must call those loans. Well, your debt is the bank's asset. So when the bank has to start calling loans or writing off the value of their asset because their asset's now gone down in value, it makes them insolvent because their assets are way low. They still have their outstanding debts. And you probably have some more flight of deposits from the banks because people can go park their money in a CD or a money market in a brokerage account and make a higher return than on a checking account. Banks just go insolvent and you have another savings and loan banking crisis. So I hope that I don't think inflation's that bad. And Jamie Dimon's a smart guy. Like I listen to what he says, but if inflation's that bad that the Fed actually leaves rates at 7 for very long, I think they trigger a true banking and credit crisis that puts the economy in much worse than what we saw in 2008. So I hope that doesn't happen, but that's how those things can happen because then it's a ripple effect. Like it hits commercial real estate, it hits REITs, it hits companies that are holding real estate in their portfolio, it hits banks, the stock market tanks. Like it's a really bad end if that's, what we end up with, in my opinion.
Yeah, when
And
I
I'm
thought
not
about
a doomer. I'm not a doomer, but that's where that can get there pretty quickly.
That's exactly where I went. Is I put this out there and I'm like, I played what if with it, and I got to a pretty bad ending pretty quickly. So
Yeah.
I'm glad I'm not alone. Anna, where can people find you?
Great. You can find me on social media, Anna Kelly, REI Mom. My website for coaching and consulting is reimom.com, and every week here on your show.
Thank you so much.